You receive your monthly statement. The total balance is significant, perhaps $5,000 or $10,000. It looks intimidating. But then your eye drifts to the line labeled minimum payment due. It is a fraction of the total, often less than $200. You pay it. The interface turns green. You have avoided the late fee. You have maintained your current status with the credit bureaus. To the average consumer, this feels like financial responsibility. But mechanically, you have not reduced your debt. You have simply serviced the interest. From the bank's perspective, the minimum payment is not a repayment plan. It is a carefully calibrated revenue engine designed to keep you solvent enough to pay, but indebted enough to remain profitable for decades. To understand the mathematical architecture behind the minimum payment, we must first distinguish between installment debt and revolving debt. With installment debt, like a mortgage or car loan, the amortization schedule is fixed. You pay a specific amount for a specific time, and the debt reaches zero. The math forces the debt to die. However, revolving debt has no fixed lifespan. The bank is providing you with liquidity on demand. This capital costs the bank money to lend. In the United States, most major issuers calculate the minimum payment using a formula derived from the OCC guidelines. Typically, it is the sum of all interest accrued during the billing cycle, plus fees, plus just 1% of the principal balance. This structure is not accidental. It is designed to ensure the bank covers its immediate cost of capital and risk exposure without significantly reducing the asset, which in this case is your debt. To deconstruct the algorithm that makes this a trap, we will look at the mechanics of stagnant amortization. Assume a consumer holds a balance of $5,000 on a standard rewards card with a 25% annual percentage rate, or APR. The minimum payment on this account would be approximately $150. When the consumer pays this $150, the bank applies the funds according to a strict payment hierarchy. Interest is paid first. At 25% APR, roughly $105 of that payment is immediately consumed by interest charges. This leaves only $45 to reduce the actual $5,000 principal. If the consumer ceases all new spending and continues to pay only the minimum, the math reveals the severity of the design. It will not take 5 years to pay off. It will take over 20 years. By the end of this term, the consumer will have paid over $8,000 in interest alone for a $5,000 purchase. The bank has effectively sold the same capital to the user 3 times over. This is the Goldilocks zone for the issuer. If the minimum payment were lower, the balance would grow, increasing the risk of default. If the minimum payment were higher, the consumer would pay off the debt too quickly, cutting off the revenue stream. The current formula maximizes customer lifetime value while minimizing default probability. The efficiency of this system relies on a cognitive bias known as anchoring. When a human looks at a financial statement, the brain searches for a reference point to determine how much to pay. The statement is visually engineered to establish the minimum due as the target. It presents the minimum as the requirement for good standing. Psychologically, paying anything above this number feels like a loss or an optional expense, rather than a necessary reduction of liability. This creates a frictionless spending environment. It decouples the cost of purchase from the cost of payment. A consumer buying a $1,000 item does not evaluate if they have $1,000. They evaluate if they can afford the $20 increase in their monthly minimum. The trade-off is systemic stagnation. By adhering to the minimum, the consumer maintains a high credit utilization ratio for years. This depresses their credit score, which ensures that if they need to refinance, they will only qualify for high-interest loans, effectively locking them into the ecosystem. Ultimately, the minimum payment is a contractual agreement to prioritize the bank's profitability over your own net worth. It is a mechanism designed to convert a one-time purchase into a long-term annuity stream for the lender. Understanding this math is the only way to break the anchor. The system considers a minimum payment on time, but the math considers it a failure. If you found this analysis of banking mechanics useful, consider exploring the other breakdowns available in our video library. Thanks for watching.